Welcome back to the show, everybody. Today we got a great episode for you. In our beginning segment, we want to get into things to know before buying a home, and we'll also sprinkle in a little bit of real estate investment as well.
Are you looking at me for confirmation? Is that what that was?
That's you. That's the warm handoff.
Chris, stop speaking. Smile.
Do what you do. Dance.
All right. Well, look, we can all acknowledge that when you buy a home the first time, it can be a very scary thing. But I will tell you right out the gate that with all the properties that I have purchased, and I've purchased many over the years, they've never not been stressful. There's different points in your life where different things are the highest stressor for you. But even seasoned real estate investors will tell you when you buy a property, there's always a myriad of things that can and will go wrong. There's unexpected things that'll happen. This is why you have things like property inspections. This is why you have financing lined up. This is why you do all the things you can to protect and insulate yourself. And there are several different, I guess, pivots that you kind of go through as somebody who's buying a property. Number one, you buy your first property. Number two, you step up into a larger property if you're lucky. You're Saied and Haroon, for example. Not me, obviously. Same property, small, petite.
I stepped down to a smaller property just for reference.
A smaller multi-million-dollar property, I understand.
Multi-million? That's not factual.
I'm just saying. So, and then when you get into the seasoned real estate investor group, there is a point where you can no longer really buy single-family residence homes anymore because you've hit what is technically a kind of a cap set by the GSEs, the government-sponsored enterprises. Mm-hmm. So Freddie Mac and Fannie Mae generally think that anything above 10 is considered additional risk, and they won't finance anybody who owns more than 10 properties on their credit report. Mm-hmm. Which is why a lot of people on social media who are like, I bought 45 properties using this crazy methodology, and I got financing on all of them. You're like, okay, from what lender?
Yeah, exactly.
Who? I guess you can go private equity or something like that, or a smaller community bank, regional bank that might do it for you, but they're going to require you to put more money down. They're generally not going to give you a 30-year amortizing loan, and it's going to be treated more like a business loan because at this point in time, you're running a business now that you've hit a certain scale.
Right.
That's always a big red flag. It's one I see a lot on social media, people who talk about scaling properties and ownership. But let's get into the nuances for the first-time home buyers, and then we will kind of layer in a little bit of extra flavor for the investors who are buying multiple properties.
Right. A key part, real quick, to what Chris mentioned that I know I've had some conversations with some people that they didn't realize this is you get better financing options when you're buying a home for yourself personally. And that's what Chris was talking about by getting loans through government-sponsored enterprises.
Yes.
And then after 10, you start getting pricing for loans that are looked at more as an investment.
Well, and a lot of banks won't even touch it. So,
yeah.
And think about it from a risk perspective. This is why this happens, right? If you're buying a home and it's your first home and it's your only home, you are more than likely going to pay the mortgage above all other expenditures because you don't want to lose the place you live.
Right.
It's a worst-case event scenario that you're going to lose your property. But by large account, all outward measures and large accounts, I can't speak very well tonight, so just make that sound articulate in your own head. By all outward measures, you have a lower probability of default on a property if you own one and it is your only one or your first time or multiple time buyer if it's the property you're living in. Mm-hmm. Once you get to a point where you have like a second home, a vacation home or something like that, or you have a rental property, the probability of you defaulting goes up significantly because that is an income-producing property for you or a leisure additional benefit to your life property.
Right.
You don't need it to live. It's nice to have.
And the lender will most likely require you to put even more of a down payment.
Right. So what that generally means is you get better pricing because the lower risk for you buying a home, when you start providing additional risk in the things that you're doing to banks, they charge up for the risk in terms of increasing your interest rate and requiring you to put more money down.
Yeah, to have more skin in the game. But let's get into something for some of these first-time home buyers. The first question, excuse me, that you should be asking yourself is really have an honest conversation with yourself. Are you even ready to buy a home? Do you have a stable job? Have you been at your job for 2 years? We know a lot of people who are self-employed who, let's just say, aren't reporting their income on their tax returns the way maybe they should be. And then sure enough, they want to go, apply for a home loan and buy a home, but now they don't have the tax returns to support it. As an underwriter, we would be asking for 2 years worth of proof that you've been working at this said job, making as much money as you said you're making. Mm-hmm. So you really need to start planning for these things 2 years in advance.
So a good rule of thumb here is you need to understand the differences, the stratification, if you will, of where money comes from. So primarily, most people will go to a bank or a credit union they have an existing relationship with. If I have a deposit account with this place, I keep my checking and savings there. That's probably the first place I'm going to go to see if they can give me a loan. Sure, you can shop around. Sure, you can look into things. That's generally stop number one. And that'll usually give you the best interest rate possibilities. Stop number two can vary, but you can go to a private lender. Lots of private lenders out there that you probably don't recognize that are private lenders, but think of it like Quicken, Rocket Mortgage, people like that. They're not banks in the traditional sense, in that they're not leveraging money in the arbitrage sense. They generally will also make you a loan. In some cases, they're very hyper competitive these days. You might actually get better than bank financing as far as interest rates go there, depending on what type of property you're buying and what they specialize in. But there are all sorts of other specialty lenders out there, the third option, if you will, where they are willing to give you all sorts of money to do all sorts of fun things. I mean, I've seen some of them give 110% of the loan to value. So basically the purchase price plus additional 10%, they charge you a lot for it, and there's a lot of strings to pull. I've seen some of them do what's tantamount to an income, non-income verified loan, if you will, where essentially they're just looking at your bank statements. They're just looking at those bank statements to say, hey, I can see Saied has reoccurring income that is tantamount to this much per year on average for the last 2 years. So I believe that Saied can pay the mortgage. The farther you go down that chain, generally speaking, the more expensive it's going to be for you to get financing.
Yes.
And this is where the broker comes in. If you got good credit and you're in a good financial position and you can go to a bank or you can go to somebody like a Rocket Mortgage, go direct to them. If you can't do that or you're struggling and it's becoming difficult for you to find somebody who will finance you because you've been declined one or two places, that's where a broker comes in. A real estate broker who specializes in getting you financing will help submit you to their, quote, lenders. They have a list of option one and option two that they typically take people to in worst case event scenarios. They don't qualify at a traditional lender like your bank or like Rocket Mortgage, Quicken, or something like that out there. Lending Tree is another great example of this. Loan Depot, another example. If they can't qualify you or you're having some challenges there, generally speaking, a broker will have somebody that they can take you to try to fill that gap if they can. If they can't, then it might not be your time to get a home.
Right. So if you would go directly to a lender, you'll probably get a more favorable rate, right, versus going to a broker. One of the other benefits of going to a broker is you have one point of contact that you're dealing with. They really take care of everything for you from beginning to end.
Mm-hmm.
And the way they get paid is they get paid through the lender, but the way the lender is able to pay them is they charge you a slightly higher rate.
Well, it depends. Some brokers will charge you direct.
Yeah.
It really comes down to your situation. Some brokers will be like, look, I can't get a fee from the lender on this, so I'm going to charge you 1% direct.
Right.
There's all sorts of different ways this can go down. But suffice, and my father's a broker. I'm a real estate broker license anyway. I've been down that. I have nothing but respect for the space. But what I'll tell you is, if you want the best possible rate, try to go direct if you can.
Yes. And then the next step is, let's just say you got that all under wraps. You've been working at a steady job for over 2 years. You're making good money. You're very disciplined. You got good credit. And now you want to figure out how much do you qualify and what is your buying power, right?
Yeah.
So that's another thing that a broker can help you with. Now you can very much do this research on your own and figure this out yourself, right? But what you're
it is intimidating. Let's take a pause there.
Yeah.
I know it's intimidating.
Right.
I know a lot of people, when they think about buying a home, they're like, oh, fuck, man, homes are expensive. That's a lot of money. I don't even know how much I can put down. I don't know how much I can buy. And they really, really, really struggle to get started with this because it's scary. The idea is scary. And the other part about it is you start calculating things. You're kind of guesstimating, right?
Mm-hmm.
Insurance and taxes. You're kind of just ballparking it. And you're like, I don't have the experience to be doing this. Is this number right? You don't have to be right. You just got to be close enough to where you get an idea of whether you can afford this.
Right. And what goes into figuring out what your buying power is you should be doing this before you even go shopping around for a home with your real estate agent, right? You go to your lender or you go to your broker and you figure out how big of a loan do you even qualify for. Now, you don't want to stretch yourself out too thin, right? But you take that amount and you also look at how much money you have to put down as your down payment. You combine the two. That's technically your buying power, right? But you want to make sure you're not stretching yourself out so thin. So that way you know what market you can get into, what neighborhoods you can get into, and then you have to also factor in your closing costs and how much you want to leave for yourself for reserves.
Can you break that down?
Yeah,
like by
I got
numbers?
that. Yeah, I knew he skipped over it. I knew you were going to think that. I'm so in sync with you right now, Haroon. I feel like I'm inside of you,
Oh yeah.
inside your head. Well done.
Welcome back.
So I want to be clear here that you need to go online and figure out. There's plenty of calculators. I'll probably put a link in the show notes for you to see a similar calculator so you can kind of figure out what you qualify for based on your income, based on the money you can put down. You need to have a rough estimate on your own before you talk to anyone. And I know that sounds like a lot. It's not that hard. You just put some numbers into a calculator and you can kind of ballpark it. The reason why is at some point in time, if you're going to look at a property, you need to be either pre-approved or pre-qualified for a home of that price. And I'll explain what this all means. Basically, you're going to need to find a lender who's willing to finance you for a home up to a certain value that you've identified. If you've done this homework, you can identify what you think a home value that you can afford is. Then you will take your tax return, your pay stubs, your financial information that your lender will require. You'll give it to your lender, and your lender will say, okay, Saied can get a loan up to $500,000 for a home, or can buy a home up to $500,000. And what that basically means, the lender has looked at your finances, and they've either pre-qualified you, qualified you in advance, or just pre-approved you for that. A pre-approval is superior than a pre-qualification. It means they've looked at everything, they've already underwritten you, they're going to approve you for this loan.
Right. And that looks very good in the eyes of the seller.
Which is what you're going to in turn do with it. When you go to shop for a home, you now know the home that you feel comfortable you can afford. You requested a loan of that amount. You've been approved for a loan of that amount subject to finding a property. You take that pre-approval letter out with you to go look at properties. And whenever you say, hey, you know what, Chris, I like this property. Let's make an offer on it. Part of your offer will be a pre-approved letter from your lender saying, hey, Saied, he wants to buy this property. He's making an offer of $500,000. Here's his pre-approval letter of $500,000. And oh, by the way, here's the required 10 or 20% down that his lender did the math on for the pre-approval letter. Here's the evidence of that liquidity from his bank statement from his bank.
Right.
And that gives you a complete offer package. Obviously, you have to negotiate terms and things of that nature. But those things smashed together, smushed together, and given to a seller is what's going to really give you a best chance at winning an opportunity to buy a property.
Right. And you don't necessarily have to feel like you have to remember each and every single one of these things. Any halfway decent real estate agent should be telling you these things as well. And they're going to be asking you to get these things before you guys even go start looking at properties.
Yeah, a good real estate agent, if you start there, and some people do, which is all good, if you start there, should shepherd you through this process. Generally speaking, a good real estate agent will also have a relationship with a lender they constantly work with or frequently work with. And they'll say, okay, you know what, you don't have a lender of your own, go work with my friend here, Kevin, at this company or whatever it might be. So there's different contact points, and everybody in this ecosystem benefits from you buying, right? Your lender's going to benefit from you getting a loan from you. Your broker, if you have a mortgage broker, is going to benefit for you getting the loan for you. The real estate agent is going to get a benefit of you buying the property. So they all want you to get the property.
Yes.
So it kind of comes down to that, but you have to kind of understand what happens next because there are some nuances. And again, seasoned professionals will walk you through this, but generally speaking, they don't unless you ask. And some people feel embarrassed to ask questions because they feel like they should know all these things because they're buying a property and they're wearing their big boy or big girl pants.
Right. Exactly. So back to Chris's example where he said Saied got approved for a $500,000 loan.
Yeah.
Let's just say I go out now. I'm thinking, okay, I have roughly $120,000 that I could put down towards a down payment. I'm also accounting for future closing costs of this loan and some money as reserves in case anything happens down the road, right? Let's go. I see a property that's listed for sale and I want to win this deal.
Mm-hmm.
So right now, luckily for all buyers out right now, we're back to normalized times. Approximately 26% of all sales right now are being sold above list price, and that's pretty normal. That was around pre-pandemic numbers.
There's still not about 6 months of inventory in all regions, but it's getting better.
It's getting a little bit better, right? So let's just say you want to sweeten the deal a little bit and you go above list. This is something that you have to make sure you keep in mind. If you do go above list,
the property's listed for sale price.
Right. And let's just say the property's listed for sale at $585,000. And I want to sweeten the deal and I offer $600,000. Okay. And the appraisal comes back in at $585,000. I am responsible for that difference of $15,000. Okay. That money will have to come out of my pocket. The lender will not finance it.
No. Right.
And in most cases, right, in normalized times, you should be able to renegotiate maybe that price down, meet them halfway, but there's some wiggle room for negotiation. Let's just say, for the sake of the argument, the seller's not willing to budge, right? Now you have to decide whether do I want to walk away from this property Or do I want to fork over that $15,000? If you do, that will eat into your down payment, right? And if you don't have enough liquidity reserve to fork over the rest of that, you might now be in a position to where you're no longer putting 20% down and you're now somewhere in the 17% range and going to have to start paying PMI as well.
So a few things to answer Arun's question from earlier in this prolongated answer that I think are important kind of metrics for you to understand. We have underwritten a lot of loans over the years, Saied and I, and one of the things I can tell you that kind of unilaterally across all lenders is they want to see typically 6 months of PITI afterward. Principal, interest, taxes, and insurance monthly, your payment, times 6 in post-closing liquidity. So, for example here, let's just say your mortgage payment, all in, principal, interest, taxes, and insurance is $2,000 a month. That's what you're going to pay every single month to keep that property, because you're impounding for taxes and insurance, meaning that your lender is going to take your annual payment for your taxes and insurance, divide by 12, and then bill you for that. So you're paying 1/12 of your taxes and 1/12 of your insurance every single month. The benefit to you is you don't have to have a lump sum payment come in the mail to pay your property taxes or pay your property insurance every single year. You just pay it as part of your mortgage payment. I generally recommend that for first-time home buyers. Seasoned real estate investors say, hey, Chris, I can make more money investing that money than I can just putting it in a reserve account for them to pay my taxes for it. So I'd rather just deal with that bill when it comes up. I impound for everything, even my investment properties. Yes, it makes my monthly mortgage payment more expensive, but it's one less headache for me to worry about because I have a day job.
I impound as well.
Exactly. And most people do. And Haroon does as well, too, because he loves pounding. One of the things I'll tell you about this process is if you have 6 months of $2,000 a month, $12,000 in post-close liquidity, you should be fine.
Yeah.
If you have less than that, generally speaking, the lender will say, you know what? This home is a bit of a stretch for you. You also have to consider things like PMI, as Saied mentioned, private mortgage insurance. So for decades and decades and decades, the mortgage market has been based off the concept of 30-year amortization, financing your home and paying back the loan over the course of 30 years. There might come a time in the future where a 40-year loan solves some of the affordability issues if home prices don't decline at any point in the not too distant future. So I think you'll probably see lenders talk about doing that to stretch out the mortgage payments, to make them a little bit lower and stretch it over time, which will in turn increase values even more as more people buy because now they have a longer time to repay it. So because 80% of the purchase price is what they've agreed to finance in most cases, you put down 20%, the bank will finance up to 80%. That's considered enough buffer of their risk. Once they finance more than 80%, they require you to pay private mortgage insurance, which insures the bank from risk of loss of you defaulting.
Right. And that could range anywhere to, I think, a fraction of a percentage to 2% of the loan, right? Or the sale price of the house.
Now, the good news is it isn't there permanently.
Yes.
Once your home approaches, once you pay down the mortgage enough, principal and interest, and you pay down the principal enough, or if your home value appreciates enough and you're at an 80% loan to value, you can actually request to have that reappraised and have that taken off. So it's not a permanent thing. A lot of first-time home buyers will go this route. Private mortgage insurance is not super heavy. It can actually not be significant enough in some cases to dissuade you from doing it.
For reference point, this is exactly what happened to me, and this exact scenario happened to me, where I agreed to pay above the appraisal price, and it ate into my down payment, which caused me to have to only put 17% down versus the 20% I wanted to put down. I paid PMI for about 6 months. Then they called it recasting. I recasted the loan, and lucky for me, after 6 months, the home appraised for higher, and the value had gone up over that time period, and they just dropped my PMI. Yeah.
And that's what happens for most people, is at least if they're savvy enough, because there's no point in keeping it back beyond that. And a good bank or lender will let you know that you can possibly get that off at some point in time. Because nobody wants you to pay it, and the bank doesn't really benefit from it unless you default and they need to use the insurance.
Yeah, because that money doesn't go towards the principal or interest. It just goes to them pocketing that money.
So a few things to note here. If you're buying a home as a second home, or you're buying an investment property, there's really not a PMI set of circumstances for you. You're going to have to put down 20% or more. Just know that going in. Somebody will say, oh, Chris, oh my God, no, I've got a lender who will do that. I don't care about your special circumstances. That's the general rule, all right? This is up to 10 properties. When you get above, call it 7 or 8 properties, and I've been there in my life before, on your credit report, it can become very difficult to find financing. Everybody sees you as an extra risk at that point in time because you just have too many obligations. One of the things I see investors do a lot here, which is just a critical fatal error, is they say, okay, here's what's going to happen. Okay, I'm going to buy this home for $1 million, and then I'm going to put down 200,000, and it's 800,000, and mortgage that I'm going to finance, and because I'm going to rent it out, I'm going to make this extra money. And that extra money will be used to pay the mortgage payment. No. The bank is going to qualify you based on the income you already have in place, and they're going to assume, even if you use it as a rental property, that you have the cash flow to cover that.
Right. So
which is a big disconnect.
Big disconnect, right? Exactly. So if all of these loans that you have on let's say to Chris's example, you have 10 properties on your credit report, right? You have 10 different loans. They're going to underwrite you to what they call a global cash flow, right? They're going to make sure that the income that you're making can service all of these loans. It doesn't matter if you're renting them out. Well done, sir.
That's for you. Yeah, golf clap like that. Thank you.
Golf clap. Yeah, exactly. So yeah, that was a really good point to make. And here's some other things that we think definitely worth noting. I see people get really excited during this time and they get a little carried away, right? But when you're in the loan process, there's a lot of things that to you and I might seem like is general knowledge, but people get excited, man. They get carried away. So when your loan is in underwriting and even after it's approved, you want to make sure that you're not out there spending more money, right? Because you can't do anything until this thing closes and you have the keys. You don't want to go apply for a new car loan, right? You don't want to add a new credit card. You don't want to rack up more debt. Why would people rack up more debt? They're already buying furniture for the house that they haven't even got the keys for yet. You can easily see how this happens. Something else that'll happen is if parents are gifting you money and you make a large deposit, towards the end of the loan, they're going to ask for updated bank statements. And they're going to see, oh, wait, you just got $20,000 deposited into your account. What was that? What was that for? Where'd that come from? Right? And you're going to have to now explain everything. You don't want any large deposits coming in that's not ordinary, right? You don't want to co-sign for anyone on a loan, like a car loan. Something that I know that has happened before is if I've had friends where they've co-signed for people, and then when they go to apply for a loan, they have to show proof that it was for somebody else, and they have to show 12 months worth of payments coming out of the other person's account. Otherwise, they go, no, you co-signed it. That's your obligation.
Yep.
So just more and more headaches. So you just want to make sure that you avoid all of these things.
I've had a lot of throat clearing issues lately. So.
I feel like tonight I have some too.
Yeah, I think it's both of us. I think we're allergic to a room.
Back-to-back
weekends.
And back-to-back weeks and all it's... Whew. Plus, now he's got
That's actually a question that I
had
had for Chris as well. What are some common mistakes a lot of first-time homebuyers make?
Ooh, yeah.
I know there's a lot. I mean, I was one of them.
No, I think people tend to fall in love with the first properties they see. I always recommend that first-time home buyers don't do that. You got to understand that this is not a guarantee that you're gonna be able to win a property. Now, in this economy, more than any other economy, really historically, it's been kind of this new cadence where you make an offer, you might not get it. So don't fall in love with properties and don't get emotionally connected to them until you're down the path far enough to where your money's hard, you've had an investigation, a property inspection, and everything feels good, because there's a lot of things that can come up and change the shift here. You don't want to be emotionally connected to property, number one. Number two, understand that this process is not simple, okay? You have to go look at properties and find properties. Even if you do it online, you got to find properties, and you have to physically go to them. There are people who will say, no, you don't have to go to them. Okay, great. If you're an investor, that maybe that works for you. I've done that with lots of properties. I have properties I've never even seen in person. I get that that's a way to do things. For a first-time home buyer, no. Okay? If you're going to live there, hell no.
Right.
That's the other thing. If you're going to live in a property, get to know the area. You got to know the area you live in, because there's a lot of weird nuances to living in areas. If it's an attached condo or townhome, spend some time in the unit. Go there during 5 or 6 p.m. when your neighbors get home or at home and are awake.
Right.
So you know what the sounds are like. You know if there's got a big dog above you, stuff like that. There's little tactile things that are going to make your life much more enjoyable if you do the due diligence up front.
Right. I definitely did that more so on this current home of mine than the first one, because this was the house that I knew I was going to stay in long term. It was walking distance to the kids' school. I wanted to make sure that I'm really happy with it. A little pro tip for everyone that I think gets overlooked a lot: check out the parking in the area. Right?
Parking is a big deal.
Parking is a big deal that a lot of people tend to overlook. For me and my family, we host a lot of like family parties, and if parking is bad, I mean, that's just going to be like a real problem.
You say you host these parties a lot?
Yeah, family parties every Sunday.
Every Sunday.
Yeah.
Wow.
Mom, dad,
No, that's
brother-in-law.
cool. Yeah, brother-in-laws, mom, dad. That's cool.
Yeah.
You know, I work on the podcast most Sundays by myself.
I work on them on Sundays too. Look at that.
Feel like you don't.
I feel like I do.
I don't.
We know.
Well, yeah. Because your work's already done by then. Yeah.
Is it though?
Well, Chris, piggybacking off of what you mentioned earlier, what are some like negotiating tips that you have for people? You were talking about like when you put an offer in.
Well, a good realtor will do this for you, and they'll be very. A good realtor has two aspects that I think is oftentimes one of the two is missing. Number one, they will handle that for you, and they will advise you on the way to do it. And number two, they will explain to you their logic and why they're doing it. They're not going to gatekeep that secret from you. Okay, I do this way because of X, Y, and Z. A lot of them just get so frustrated explaining to people that they won't do it. They'll just say, we're doing it this way, and this is how you get it. I think you need both. Negotiation tactics, don't make your highest and best offer right away. I mean, I understand that you want to win a property. That's all good. But just know if in Saeed's scenario, if the house is listed at 585 and you go out at 600, you might get a counteroffer for more than that.
Yeah.
Put in the offer you think will get you a counteroffer. And I know that sounds counterintuitive because you don't know and someone could bid crazy money. But if you're starting off above this and that's your highest and best, you could very easily get a counteroffer above that. And you could say, I gave you my highest and best. And they go, oh.
Yeah. This is actually something that Chris saved me a lot of money during my process, right? So the house actually got appraised, the current house that we live in actually got appraised for $30,000 less than their initial list price. The offer I made was right at list.
Yeah.
It came in at $30,000 less, right? My initial gut reaction, because I was so eager to get into the home, it was within walking distance of the school, and you just feel this immense amount of pressure during this time that you just want to tell yourself, whatever it takes, I don't care, just close the deal, And Chris was very, very calm, and he sat me and my wife down and was like, guys, don't be afraid to walk away from the property. You're not married to this property, right? And it was because of Chris that got me comfortable with that idea that I was willing to now renegotiate, right?
I actually kind of wanted you guys to lose the property, to be honest with you.
I know you did. But because of that, we went back. I was willing to pay the 30, but we went back to negotiating with them, and then we ended up meeting halfway in the middle.
That listing agent hated me,
dude, and that saved me $15,000.
Well, there's different ways of negotiating as well without just the price, right? There's things that you can waive.
Yeah, well, there's inspections and things like that. I don't recommend people, and people got really into this.
Closing costs. Yeah.
They would waive like inspection, contingency. Their money was hard, within a week, and you couldn't. There's lots of things you can waive. Don't waive any of those things.
Don't waive anything, but also if you're going into this process, don't bank on the fact that those things are going to happen for you either, right? Like if you're banking on the fact that the seller's going to, cover your closing costs and you're going to need that in order for you to even qualify for a home, like then now's not the right time for you.